How's it going, ladies and gentlemen? I've gotten multiple requests from viewers and subscribers about doing a video on short-term bond funds. And so today we're going to cover the top 4 performing Vanguard short-term bond fund ETFs. So I hope you guys enjoy. We're going to talk about the 4 they offer, and then towards the end of the video, we're going to look at some comparisons that are really important. And then more importantly, we're going to look at some reasons why you should invest or not invest in short-term bonds, and just having some general bond knowledge in general and how it works relative to the rest of the market. So please stick around for the rest of the video and make sure to hit the like button on the video if you enjoy it. Let's get started. The first bond fund we're talking about today is BSV, and actually I was talking about this one with a financial advisor the other day. It's the Vanguard Short-Term Bond Fund ETF. Date of research on all this stuff, guys, is right around November 1st, so there might be some small fluctuations in performance, so just keep that in mind. And on each tab, for each different bond fund we're going to be talking about, there's a blue link right here that you guys can click on to take you directly to the Vanguard's website to learn more about this bond fund ETF. The annual yield on pretty much all of these is going to range from about 1.5% all the way to 3% or so. So right in that range. So you're not getting an incredibly high yield. Now, just so you guys know, what is a short-term bond? Does anybody know? Well, a short-term bond is considered any bond fund with a maturity date of 2 years or less. A maturity date above 2 years is all the way up to 10 years is considered intermediate, and a maturity date longer than 10 years is considered a long-term bond fund, or a long-term bond basically. So in general, we're talking about bond funds or bonds here that have a maturity of 2 years or less. You're gonna find that many of them, as we go along, have a maturity of 3 years or less. So this one has an annual yield of 1.86% annually. Doesn't pay much, but it does pay monthly. So you can expect a monthly dividend payout distribution to your account every single month. The beta on these things, guys, is very low, so it's hardly volatile at all compared to the rest of the market. It brings stability, which you guys are gonna see here. Year-to-date return we're down about 1%, which is not bad. Now remember, we've seen interest rates rising for the past year or so, and they keep ticking up and ticking up. Now, short-term bond funds, the good news is, although they are impacted some by rising interest rate, it does hurt them a little bit. They're not as impacted as an intermediate bond or a long-term bond. So actually, long-term bonds are the most affected by rising interest rates, and it's been hurting them because since the 1970s, interest rates have been falling. So now we've bottomed out for the most part on interest rates, and they're finally starting to move up. And so as they move up, they're hurting some of these bonds. Like I said, short-term is going to be hurt the least. Okay, years in existence. This one's been around 11 years. You can see the price on this is about 78 bucks, guys. I'll let you guys read up on all of this stuff. A couple things I want to point out before we move on to the next one. I've included the average annual return. Remember, I said average annual return. But as you can see here, you're not really getting growth on this investment because bonds aren't generally for growth. So you can see here we're down for the year. Year to date, we're down about 1.3% on this thing. 5 years, it maybe grows maybe 1% per year, if that. So don't really be looking for growth. If I were you, I would not be thinking of buying this for growth purposes. You're really buying a short-term bond fund for 1, fixed income, or 2, to hedge your risk, in which we're going to talk about more later on in this video. Okay, so in terms of their holdings, I've included the holdings of what kinds of debt instruments it holds or what industries it holds the debt within. As you guys can see here, finance, it holds about 11.5%. Most of this is US government debt. So that's the majority of it, with a little bit in foreign debt as well. You guys will see that I've included the credit quality ratings on each of these bond funds. US government is the highest rating, which means it's the most secure, followed by AAA, AA, etc. That basically says that the higher that rating is, the higher the likelihood that those debts will be repaid back, so you can feel more secure in your investment. Also, as you can see, I've included the holdings. Look at this. From their top holdings are primarily United States Treasury bonds, as I've mentioned. There's a whole lot of US debt in this thing. And so let's look at a graph now, guys. Okay, so see this blue line down here? That's the bond fund. See this black line? That is the S&P 500. That's what that is. This graph is year to date. It's hard to see that, but notice it's a steady pattern. It goes up a little bit, it goes down a little bit. So it
pretty much holds its value pretty steady.
And that's part of the reason bonds are good to hedge your risks. Now, especially short-term bonds. In a volatile market, it can hold the value of your cash pretty steady while still giving you an annual yield, which is kind of nice. In plain English, the S&P 500 could go way down, the Dow Jones could go way down, but this would pretty much maintain most of its value. That's the theory behind this. That's the risk management and the hedging you're doing by owning some short-term bonds in your portfolio. All right, guys, the next bond fund we're looking at is VTIP, our Vanguard's inflation-protected bond. It has an annual yield of 3.22%. It pays quarterly, which basically means that 4 times a year you're going to get a dividend distribution on this bond fund. Beta is even less than the previous one, which even means it's less volatile than BSV. Year-to-date return is minus 1% because interest rates have hurt these bonds a little bit. It's been in existence for 11 years, just like the last one. And you can, in your own time, if you download the spreadsheet or pause the video, you can read this information on it. But basically, the yield's going to track a little bit more with inflation so that your cash or your underlying investments will have a better chance of keeping pace with inflation. Here's the average annual returns, as you guys can see, about 1% for 1 year. 3 years is about 1.31%. 5 years is about 0.5%. So really, like I said, guys, performance is really nothing to talk about here because they're all about the same. They all have hardly gone up any in value because they're really not meant to be a growth type of investment. Distribution by user. So these are 100% in US Treasuries. The previous ones had some foreign debt and some financial sector debt, but this one is all the debt is found in the US Treasury, and the bond rating is very high as you're looking at 100% government rated credit quality bonds. Here is the year-to-date graph on this one. You guys can see the S&P 500 is in black. It has fallen about 1.8%, but the bond, this VTIP, is only down about 1%. So it's maintaining more of its value. And here's 15 holdings. Look at this, guys. It's all US Treasury inflation index bonds. Lots of government debt, just like we were talking about. Moving on now to VGSH, which is Vanguard's Short-Term Treasury ETF. Annual yield is about 1.5, pays monthly, which is nice. Beta is 0.25. Year-to-date return is it's just above zero at 0.2%. It's been in existence for 10 years. It currently has a price of about $60 per share of this ETF, this bond ETF. And let's go down here. If you guys can read the summary at your own time. I'm not going to talk about it in performance because I think there's some other more important stuff to talk about on this. Let's look at the graph real quick. As you guys notice, are you seeing patterns here? I'm totally seeing patterns. The graphs look almost identical on every single one of these bond funds. So really, it's just up to you to know the length of the maturity in these things, like how many different types of maturity bonds we have in this. Is it 1 year, 2 years, 3 years? Like I said, most of them have a maturity of 3 years or less, is the bonds that are held within these different ETFs. And the only other difference is the type of debt they hold. So like this one is 100%, once again, US Treasury debt. You can see here that I've included the maturity distribution on this one. I realize I forgot to include it on the others, but this one has almost all of them have a 1 to 3 year maturity, with a very small percentage of the bonds with a maturity more than 3 years. Once again, credit quality is pretty much almost 100% government, US credit quality. Okay, moving on to the final one, which is VCSH. I know I'm going kind of fast, guys, but that's on purpose, so we can get through the information quickly so you can move on with your day. I can move on with my day, but just to give you enough information to be dangerous with this kind of stuff.
I like to live dangerously.
Is my goal here. Annual yield is 2.5%. This is the Vanguard short-term corporate bond funds. Now, corporate bond funds do pay a little bit more on average. If you guys remember from my Vanguard Long-Term Bond Funds, we saw the highest rates of return in terms of an annual yield. You're gonna find that on your corporate bond funds. Beta is 0.46. Year-to-date return is hardly above zero. So who really cares? Years in existence is about 9. You notice, like, on every single one of these, the risk potential is 1, because these are the lowest risk investments, or some of the lowest risk investments you can find. It's currently about $78 per share of this ETF at the moment. I'm gonna skip this part about the average annual returns because it's obvious. They're all about the same on each one of these funds. But let's look at the credit quality here, guys. Credit quality, because it's corporate debt. Now, this is very important. It's corporate debt, which means it's riskier, or it can be riskier, because obviously businesses can go bankrupt. They can go out of business and things like that. So there's far fewer bonds with AAA ratings. And look at this. It's like negative 0.1%, which I'm not sure how you get a negative 0.1%, but I guess you can in terms of US government credit quality rating. And of course, the average effective maturity on these things, guys, is about 3 years. I'm gonna skip the graph on this one, guys, because it's pretty much similar to the other ones. But this one has over 2,000 bonds within it in all different companies, different kinds of debt, different maturity dates, and so on and so forth. But as you guys can see here, Anheuser-Busch, or Budweiser, is the #1 debtor here. Bank of America, CVS Health Corporation, General Electric, Apple, Verizon Communications. Now, I don't know if you guys remember this, but if you remember the Vanguard Long-Term video, the corporate bond funds in that had the same companies. So these same companies are also can be found with the short-term bonds. I bet you, if we look at intermediate-term bonds, I bet you these are the debtors there as well, would be my guess. All right, ladies and gentlemen, now we are in the final part of the video where we do the comparison. And you guys can just read it all the way across to see how they've been doing in terms of average annual returns. And since inception, you can see that the best performing in terms of overall growth is going to be BSV and VCSH. However, you have to also consider the yields though, because the yields aren't always the same. And so there's all the yield information can be found right here. So you can compare all these things side by side and see which one's right for you. Read the product investment summaries and things like that and get some good knowledge before you're purchasing these guys. But just remember that all of these are pretty low risk, especially, and they're good in a volatile market, which we'll talk about here in just a second. Okay, let's go down here and look at the graphs. So I've ran several graphs for you guys. And this is the first one is the 5-year graph. And so you can study the movement of how these things interact. You're gonna be able to see that here. Then we have the maximum or since inception graph, and you guys can see that VCSH has probably performed the best out of all of them in the long run, and it's the corporate bond fund, so it's a little bit more volatile. And so that's why there might be, it's a little bit more riskier, it's a little bit more volatile, which is probably why there's a little bit more growth behind this particular investment. Moving down the list here, there's the two-year comparison. I'll let you guys pause the video on these and study that. But let's go down here. Here's year-to-date. I have year-to-date. And then there's one I wanted to show you, which is really makes the good use of short-term bonds and really drives the point home. As I said earlier in the video, a short-term bond can be good to hedge risk. And as you can see here, so in the past 3 months, we know the markets have been very volatile. And as rising interest rates, we have midterms coming up. We had, what else do we have? We have, trade wars potentially going on. So just a lot of stuff going on right now. And the black line here, I want you guys to see this, is the S&P 500. But what you'll notice is the S&P 500 is down 5.8% over the last 5 months. But look at the bond funds. They're hardly down at all. And that's the beauty of investing in short-term bonds, especially in a volatile market. So you're basically getting some risk protection because it's helping maintain the value of your investments, and you're getting an annual yield. It's not significant. Let's be honest, you would need several million in these bond funds to even, be able to afford to live purely off the dividend distributions or interest, the yield it brings. But you can see though that in a volatile market, bonds are routinely hold their value. At the back of the spreadsheet, guys, which I hope you really take the time to download it, I've included a bunch of links on good articles to read up on bonds. Really, to learn this stuff, if you ask, well, Mike, how'd you learn about it? It just takes time and research and just read about it. Read about it and then visually look at graphs and see how these things perform in different markets. If you run them against each other, things like that, and you'll start to get a better and better understanding of how these bonds work. Remember, short-term bonds are about a 2-year maturity or less. We did see some bond funds in here that have a maturity yield of 3 years or higher, but it's very rare. For the most part, there are 3 years or less in terms of your average annual maturity. Now, take time to read these guys. I got some good information for you in here about how to choose the right bond fund. It talks about the relationship between risk and yield, bond performance during times of rising and falling interest rates. So these are some cool articles I found. This is a cool article that compares bond funds, the short-term bond funds in particular, to money market funds. So this is a fun article to read by Investopedia. Investopedia writes a lot of good articles. They're one of the best resources I can find on investing. So make sure to read up on some of their stuff and just read a variety of articles, and you'll start to learn more and more about these things over time. All right, guys, well, thank you so much for taking the time to watch this video. I hope you learned something new today. I had a lot of fun making it, and I really appreciate the request and the ideas, and it was a lot of fun to make this one. So if you guys liked the video today, make sure you drop a like before you leave. Be sure to share this information with a friend, especially somebody who's into investing or someone who needs to protect their capital in these volatile market times where with rising interest rates and things going on, we don't know where the market's going to be headed soon because we've been in a bull market for so long. They might find this information helpful to protect some of the value of the assets within their account. If you have not already subscribed, be sure to do so, as every single week here on Money and Life TV, we make new videos that cover finances, investing, and taxes so that we can get you fiscally fit. In the comment section down below, guys, of these 4 short-term bond funds, which one would you most likely invest in? Or what type of bond funds in general do you look at? Do you look at short-term, intermediate, long-term? Which ones do you prefer to invest in and why? I would love to hear from you guys down in the comment section down below, and that's where I'll see you. All right, guys, have a great week, everybody. Love you all. Remember now to take this information and use it to live your life uncaged. See you in the next video, guys. Peace.